Welcome back. You're tuned into Editors Roundtable here on CNBC-TV18. Well, India seems to be in a sweet spot, as we've been telling you. It may not be a linear line for the markets of the economy, but we seem to be heading in the right direction. And the reason I say that is because of three broad themes. One is financialization of savings, digitization and formalization of the economy as well. Let's start off with formalization of the economy. GST collections, I recall us celebrating when we were hitting around 1 lakh crore odd. For the last 6 months, we have been hovering around the 1.4 lakh crore odd. So that's positive. Jan Dhan accounts, we just take a look at the way it's moved. From around 15 crore accounts, we're at around 45 crore accounts. And what's better is close to around 80% of those, well, they are actually operational. And the amount in every account has moved from around 1,200 odd all the way to around 4,000 rupees. Now, the other factor, financialization of savings. Household savings, if you look at equities as a percentage of savings, well, that was in the low single digits. That's gradually moved to around 5%. And I believe that it's moving towards, the double digits and high single digits odd. And we have a long way to go because Western world, well, it's anything between 20 to around 30%. In some cases, even more than that. Besides that, there is an equity cult here in India. From, in the last 3 years or so, the total number of demat accounts, well, that's been the big talking point all this week, right? We're at around 10 crore odd. Moving on then, the average monthly SIPs. Remember, just a few years ago, we were at around 4,000 odd. Just take a look at the way we're going. We're clocking close to around 12,000 crores in terms of average SIPs. In the last 5 years, we're up close to around 4 times odd. The Indian mutual fund industry as well, we have the average assets under management. Well, that's moved up big time. Moved up by nearly around 5 times in the last 10 years or so. And that's the updated number that we got at the end of this week itself. The digitization theme continues to play out, and that's very encouraging as well. The UPI transaction, just take a look at the growth. For the month of August, big time growth, in comparison, both the number of transactions as well as the quantum in terms of values. And finally, dematerialization of insurance policies. Personally, I think this is going to be really, really good news. All the new insurance policies that will be taken, they'll have to be dematerialized. Not just that, even the ones that have been taken in the past, they as well will have to be dematerialized. So that's telling you the kind of digitization drive that's on the ground. Stocks that you need to focus on, well, self-explanatory. Up for you on the screen as well. Short point is India in the right direction, onwards and upwards. Back to you guys.
Okay, Nigel, thanks a lot for that. And to discuss all of this, we have with us Nilesh Shah, Managing Director at Kotak Mahindra AMC. Nilesh bhai, good evening. Thanks for joining us. Clearly, it's the domestic retail investor who I think should salute themselves, right? They have kept themselves in the game in a market in which there was so much against them. But do you get a sense that the market's getting a bit exuberant, or is it fine? Your thoughts?
So Anuj bhai, if we look at the world, there is a massive sandstorm blowing out there. If we look inside India, it looks like oasis in the desert. So shorter term fundamentals of India will get impacted by global sandstorm. But once the dust settles, we will be the only oasis in the world. From a flow point of view, we have seen massive turnaround in foreign portfolio flows. In a market where both local and foreigners are buying and IPO supply is not emerging, there is only one way for prices to go. The third thing, Anuj bhai, I met a global investor, and while presenting India, I was talking that we are now at a significant premium to MSCI Emerging Market Index. And he told me, Nilesh bhai, nazariya badaliye. You are looking at 1 year valuation. In my position, I am looking at 5-year valuation. India is the cheapest emerging market. So we are right now in a positive territory of fundamentals and flows. But please remember while investing that there is a massive global sandstorm blowing.
Nilesh, good evening and thanks for joining us. I was also discussing about why the Indian macros are doing much better than the global macros, right? And one data point that stood out for me is the corporate profit to GDP ratio, which is now at a decadal high of 4.3% this year so far. Since corporate profitability is increasing, I want to understand from you which are the pockets where you're seeing the maximum amount of traction. We do know that there's a structural shift that we're seeing in the banking space, but according to you, what stands out for the next, say, 12 to 18 months?
Over the next 12 to 18 months, banks will have better profitability as interest rates start stabilizing and all the treasury losses which people have booked starts getting converted into income. The second sector where we see profitability picking up pace is industrials and capital goods. This companies cut costs to survive last 4 or 5 years of period where order book was not growing that fast. Now, not only they get orders from Government of India, private capital, and also exports market. The operating leverage is kicking in capital goods, and we believe profitability growth there will be superior. Probably the only disappointment on the profitability side is likely to come from sectors like pharma or IT, where it is the margin which is getting impacted. But even there, the profitability growth will still be positive. So overall, we are in a sweet spot where corporate earnings could easily grow anywhere between 15 to 20% over next 2 to 3 years.
Hi, Nilesh. Nilesh, a very simple question. Suddenly, people are now started talking about the 20,000 mark on the Nifty. For after a while, when you wake up in the morning, if the SGX is down 150, 200 points, there's a lot of happiness because people say we're going to get in. Your guess, early 2023, you think 20,000 on the cards?
Nigel, but it's always difficult to predict short-term movement. But definitely in year 2023, we will see 20,000 coming.
Okay, year 2023 we see 20,000. Actually, that will be slightly disappointing if we only stick at 20,000, right?
I thought you would say 20,000 before Diwali this year. I mean, the way the market is going, it looks like it's going to be there very soon.
23,000 Nilesh, should be the aim, right? I mean, of course, not immediately, but what kind of compounding can we expect over the next 5 years? Okay, let me ask you this, since you referred to 5-year valuation.
So normally we had seen very high inflation in the past. Compared to that, our inflation is now in low single digit. So your return compounding can come down from on a nominal basis. But should we be targeting low double digit compounding? Answer is yes, that is plausible.
Okay, all right. Well, just one word before we let you go, Nilesh. What do you think could be the theme, the big theme over the next couple of months?
So Sonia, this is more a retail investor answer than institutional investor answer. India is a rising tide. All boats will get lifted as long as it doesn't have a hole. So please invest in good companies run by good managers where promoters won't take you for a ride or shortchange you. As long as you are sitting in a boat without hole, India growth story will lift everyone.
Okay, and it seems like a lot of the holes in the India boat, even if there were, are getting plugged, right? I mean, at least on the macro front, we're seeing that. Nilesh, always a pleasure speaking with you. Thanks a lot for joining in. So clearly, the exuberance, right, continues, and we've seen it in the number of demat accounts that have opened up in August as well, right? So even if there is some volatility, it looks like the uptrend at least is intact.
Yes, but you know, just to add a point, prices sometimes drive the narrative, right? We've got to be wary of the fact that right now we are in a winning streak. So we can say that. You know, one thing which I keep saying is in the market, the biggest risk is to book your position too soon in a bull market, or to wait too long in a bear market to cut your loss. I think a lot of people have realized that, Sonia. I think that's one thing which you got to trail your stops, because unless the screen throws you out, the market will throw you out if it has to. You don't make the decision. This is one thing where, you know, at the risk of sounding a bit sexist, I used to say this. You know, market is like your girlfriend. You know, you just keep her happy, and you know, just you know, do what she wants you to do, and I think you'll be happy.
And I'm a mature investor now, keeping the wife happy.
Girlfriend, boyfriend, wife, husband, you need to keep the spouse happy, right? So let's just make it market is like your spouse. You need to keep them happy, whatever it is. All right, folks, thanks a lot, editors, and thank you to our viewers for joining us on this edition of Editors Roundtable. Have a great weekend.